4 tools to avoid capital gains taxes in real estate.
My property has appreciated $1 million and I'm worried about paying capital gains tax. What can I do?
The first tool is to hold for a step up in cost basis. This is a way to completely eliminate capital gains taxes.
That sounds too good to be true.
It's true, however, this can limit tax planning flexibility, requires ongoing management of the property, and can complicate planning with multiple heirs.
Now, how would I do this?
You would put your properties into a trust and have it passed to your heirs upon your death.
Oh, that's it?
Yup, it's pretty straightforward, and there are other benefits of having properties in a trust. The second tool is to use a 1031 exchange to defer your capital gains taxes.
That's great, but what are the drawbacks?
You can only 1031 exchange for an investment property, meaning a property that you don't live in.
I have an investment property.
Also, when you sell your investment property, you have to reinvest the proceeds from the sale into a like-kind property, like a piece of real estate.
Okay, I get that. But what do you mean when you say defer the capital gains tax?
It just puts the capital gains tax off for now. But eventually, if you sell and don't 1031 exchange, you'll have to pay the capital gains taxes. However, you can continuously 1031 exchange over and over again and pass the investment properties to your heirs upon your passing, and they could sell it and pay no capital gains taxes.
You're pretty smart, huh?
This is how wealthy families build, protect, and transfer their wealth. The third tool is a Delaware statutory trust.
Adela what?
A Delaware statutory trust, also known as a DST, is considered a like-kind property, so you can 1031 exchange into a DST. A reason so many people love this is that there's no management responsibilities.
Yup, I'm sold already.
However, you don't have direct control of the DST.
Why won't I have control?
You're buying into a portion of a $100 million property that's being professionally managed, so you don't get to dictate when they sell.
That makes sense. But how long until a DST matures?
They typically hold the DST for 3 to 7 years, but it may be longer depending on the market conditions.
Oh, that's not too long.
However, another drawback is that you have to be an accredited investor to buy into a DST.
What's an accredited investor?
It's someone who has a net worth exceeding $1 million, excluding the value of the primary residence, or an annual income of $200,000, or $300,000 for joint income with your spouse.
Dang, I'm not sure if I qualify.
Yeah, a DST is not available for everyone. The fourth tool is a 721 exchange.
What's that?
It's when you 1031 exchange into a DST, then 2 years later, you exchange into an UPREIT.
Why can't I go straight into a DST?
Well, typically to get into an UPREIT, they have to want to buy your building, and they're buying $100 million buildings, right? And they have a specific criteria for what they're looking for.
Okay, well, why would I want an UPREIT?
With an UPREIT, you don't have any management responsibilities. It's a portfolio that's being professionally managed. It's easily divisible when liquidating, and a major benefit is that you don't have to continuously 1031 exchange over and over and over again. Another great benefit is that you can pull money out at a cost basis first and pay no tax.
Now, why doesn't everyone do this?
Well, you have to buy into a DST first, and that requires you to be an accredited investor. You also cannot 1031 exchange back into real estate, and it may be challenging to do with existing debt.
And what if I just sell my appreciated real estate?
Well, you would get liquid cash that you can do anything with. However, you have to pay capital gains tax, which may be up to 30%.
How will I know how much tax I will have to pay?
We can run a capital gains tax liability assessment and understand how much tax you will have to pay.